The Federal Reserve, or the Fed, for short, is the central bank of the United States. One of its key functions is to set monetary policy, including interest rates. When the Fed raises interest rates, it can have a significant impact on the economy and financial markets. In this discussion, we will explore what you need to know when the Fed raises interest rates. What are interest rates? Interest rates are the cost of borrowing money. When you borrow money, you typically have to pay interest on the amount you borrow. The interest rate is expressed as a percentage of the total amount borrowed, and can vary depending on the type of loan, the lender, and other factors. The Federal Reserve sets the target range for the federal funds rate, which is the interest rate at which banks lend to each other overnight. When the Fed raises or lowers the federal funds rate, it can have a ripple effect on other interest rates in the economy. Why does the Fed raise interest rates? The Fed typically raises interest rates when it wants to control inflation. When there is too much money in the economy, prices can rise, leading to inflation. By raising interest rates, the Fed can reduce the amount of money in circulation, which can help to control inflation. In addition to controlling inflation, the Fed may raise interest rates to cool down an overheating economy. When the economy is growing too quickly, it can lead to an increase in inflation and other economic imbalances. Raising interest rates can help to slow down economic growth and reduce the risk of a recession. What happens when the Fed raises interest rates? When the Fed raises interest rates, it can have a ripple effect on the economy and financial markets. Some possible effects include: 1. Higher borrowing costs. When interest rates rise, it becomes more expensive to borrow money. This can affect everything from mortgages to credit cards to business loans. 2. Higher savings rates. When interest rates rise, it becomes more attractive to save money. This can lead to an increase in savings rates, which can help to stabilize the economy in the long run. 3. Lower stock prices. When interest rates rise, it can make stocks less attractive to investors. This can lead to a decline in stock prices, which can affect retirement savings and other investments. 4. Stronger dollar. When interest rates rise, it can make the dollar more attractive to foreign investors. This can lead to an increase in the value of the dollar, which can make exports more expensive and reduce economic growth. What should you do when the Fed raises interest rates? When the Fed raises interest rates, it's important to take a long-term view of your investments and finances. Some possible actions to consider include: 1. Review your debts. If you have variable rate loans or credit cards, you may want to consider paying down your debts or refinancing to a fixed rate loan. 2. Consider bond investments. When interest rates rise, bond prices typically fall. However, if you hold your bonds to maturity, you will still receive the full face value of the bond. 3. Rebalance your portfolio. When interest rates rise, it can affect the balance of your portfolio. You may want to consider rebalancing your investments to ensure that you are still diversified and aligned with your long-term goals. 4. Keep a long-term perspective. When the Fed raises interest rates, it can be tempting to make short-term decisions. However, it's important to keep a long-term perspective and focus on your overall financial goals. Conclusion: in conclusion, when the Federal Reserve raises interest rates, it can have a significant impact on the economy and financial markets. By understanding what you need to know when the Fed raises interest rates, you can make informed decisions about your investments and finances. Some technical terms here need a little bit to be explained. What is a strong dollar and its impact? A strong dollar is a term used to describe a situation where the value of the US dollar relative to other currencies is high. In other words, it takes more of another currency to buy a US dollar. When the dollar is strong, the strength of the US dollar is typically measured by the US dollar index, which is a weighted average of the dollar's exchange rates with a basket of other currencies. The impacts of a strong dollar can be both positive and negative. Here are some potential impacts. Positive impacts. 1. Lower prices for imports. A strong dollar can make imports cheaper, as it takes fewer US dollars to purchase goods. and services denominated in other currencies. This can benefit consumers, who are able to purchase imported goods at lower prices. 2. Attraction of foreign investment. A strong dollar can make U.S. assets more attractive to foreign investors, as they can get more U.S. dollars for their investment when they exchange their own currency. This can lead to increased investment in U.S. stocks, bonds, and other assets, which can help to boost economic growth. 3. Lower borrowing costs. A strong dollar can lead to lower borrowing costs, as investors are willing to lend U.S. dollars at lower interest rates due to the strength of the currency. Negative impacts. 1. Higher prices for exports. A strong dollar can make U.S. exports more expensive, as it takes more foreign currency to purchase goods and services denominated in U.S. dollars. This can make U.S. exports less competitive in foreign markets, and can lead to decreased demand for U.S.-made goods. 2. Decreased tourism. A strong dollar can make it more expensive for foreign tourists to visit the U.S., as they will need more of their own currency to purchase U.S. dollars for their trip. This can lead to decreased tourism revenue for U.S. businesses. 3. Pressure on U.S. companies. A strong dollar can put pressure on U.S. companies that rely on exports or have significant foreign operations, as their profits can be reduced when the value of their foreign earnings is converted into U.S. dollars. Overall, the impacts of a strong dollar can be complex and varied, and will depend on a range of factors, including economic conditions, trade policies, and investor sentiment. Let's talk about bond. What is it? A bond is a debt security issued by a company or government entity that promises to pay the holder a fixed amount of interest over a specified period of time, and to repay the principal amount of the bond when it matures. In other words, a bond is a loan made by an investor to a borrower, with the investor receiving regular interest payments until the loan is repaid. Bonds are an important part of finance and the economy, as they provide a way for companies and governments to raise capital by borrowing money from investors. Here's how they work. 1. Issuance. A company or government entity decides to raise money by issuing bonds. They work with investment banks and other financial institutions to structure the bond offering and set the terms, such as the interest rate, maturity date, and repayment structure. 2. Purchase. Investors can buy bonds directly from the issuer or on the secondary market. When an investor buys a bond, they are effectively lending money to the issuer, and in return, they receive the right to receive interest payments and the repayment of their principal investment at the bond's maturity. 3. Interest payments. The issuer of the bond makes regular interest payments to the bondholder, usually on a semi-annual basis. The interest rate is set at the time of issuance and is typically fixed for the life of the bond. 4. Maturity and repayment. When the bond reaches its maturity date, the issuer is required to repay the principal amount of the bond to the bondholder. This payment is typically made in a lump sum and marks the end of the bond's life. Bonds are an important source of financing for companies and governments, and are used to fund a range of activities, from building infrastructure to financing growth and expansion. They are also widely used by investors as a way to diversify their portfolios and generate a steady stream of income. Bonds can be bought and sold on the secondary market, and their prices can fluctuate based on a range of factors, including interest rates, inflation, and the creditworthiness of the issuer.